Welcome back. So we're going to tackle the question of can we use any life insurance policy to create infinite banking policy? And the answer is no. The answer is no. And if you have a policy right now and you want to have it, you want to have it looked at, that's more of a case by case basis. I can certainly do that, but generally speaking, it requires a particular type of whole life by a particular type of company called a mutual life insurance company. So I'm going to try to keep this within 2 minutes. So let's get going. I'm going to use an analogy of real estate, something we all know and understand, to speak about the different types. We've got term life. Those are term and whole life are two different flavors of life insurance, and there's subcategories, categories of those. But term life is like renting. You're a tenant. You're renting property. It's cheap. It's temporary, and you don't really have a lot of control when you're renting. But it's cost effective. When you're 60, typically, when the time when you most need it, you have to relinquish it because it's cost prohibitive because it now costs too much. Whole life is more of this was the savings vehicle back in our parents' day before Wall Street really became in vogue and the masses flocked to it. But it's like owning your own property, but not really doing much with it, right? You own your own property. It's permanent coverage that builds cash value. It builds equity, offers stability. Okay. Infinite banking is more of the multi-dimensional tool. It's like the home buyer that also taps into the equity to buy rentals, taps into that equity to buy more rentals, and you're really utilizing leverage to really expand your empire and grow your wealth much, much more aggressively. That's infinite banking. And so it requires a different mindset, a different type of vehicle to do that. Whole life structured with cash value. You're using whole life cash value to finance personal loans, investments, opportunities, and the like. You're maximizing assets, utility, and growth. Self-insuring is probably the worst way you can go. It is the most woefully inefficient. It's like do-it-yourself property management. I mean, I think about that. It's like my mind just blows up trying to manage my own properties. And so relies on personal savings for future financial needs. And the key is key benefit is you have complete control. If you're one of those control fanatics, then great. Complete control, no premium costs, okay? So when we look at this like on a totem pole kind of way, we have term life here at the bottom, what's widely sold out there. You have typical permanent insurance, whole life insurance, and then you have infinite banking here, using a whole life chassis, but using specific riders to really juice up the policy, so much so that we're towing the line to where it becomes taxable, right up under the line to where the IRS says, can't see you, right? And so that's where we want to be. If you're thinking of IULs, we'll talk about that another time, but just know that the founder of this concept, Nelson Nash, doesn't like them used for the banking purposes, nor do I. IULs relying on the stock market in order to guarantee the money in your policy, and we all know that's not going to happen. So anyway, that's all I got. When you control your income, you control your outcome. Till next time, thank you.